What does it mean to recast your financials before selling your business? So as a business owner, you know that your financial statements don't necessarily represent the true cash value that you receive from your business. Your business has non-cash expenses and you have some personal expenses that are running through the business. So in order to give the buyer a true view of the earnings power of your business, you need to recast your financials, or in other words, show the true earnings power, what is typically referred to as seller discretionary earnings, or sometimes referred to as cash flow. So when we do it, we like to start with the bottom line and start adding things to it. So we're gonna go for the easy things, the non-cash items, the depreciation and amortization. We're going to add those to the bottom line net income. Then we're also going to add our interest expense, and then we're going to add any taxes that were paid if we are a C Corp. You only add back taxes if you're a C Corp. If you don't know what a C Corp is, you probably are not a C Corp and should not add back your taxes. Next, we're going to add back your salary as the owner and your payroll taxes that are associated with your income. So those are all easy add backs. Those are ones any buyer, any bank are going to give you credit for. Next are the little trickier add backs, and those are gonna be your personal expenses or one-time expenses. Now, the reason why these are trickier and a little gray is because you're gonna have to really prove these out. So if you have any expenses that were personal, not for the business, you're gonna have to really prove that. So, it's tough. A lot of business owners run their travel through their business. Maybe they go to a conference and spend the weekend there at a nice resort. That is both a personal and a business expense. So it gets tough because that's a blend. The new buyer could come in and say, well, you generated business by going to that, so that is a legitimate business expense. And then you might say something like, well, we stayed at a 5-star resort. You don't need to stay at a 5-star resort. So we'll forget about the legality of what you can and can't deduct, but that is what we see most people do. So those add backs, like we said, can be a gray area. You're gonna have to prove every one of those that it wasn't related to the business. You're gonna have to be able to produce the invoice for it and show that you paid it. And this is also true for one-time items. A lot of people wanna add back everything that happens one time. I think most business owners know that owning a business is every year you have so much in one-time expenses. They happen every year. It's just a different thing that expense is. So buyers are gonna be somewhat skeptical of one-time expenses, but a good example of a true one-time expense would be, let's say you moved your office location from one side of the city to the other, and that cost $50,000 in moving expenses. That would be an easy one-time expense. You're gonna need to show the invoice for the move and show that you paid it. And then the buyers are gonna give you credit for that cash flow that was not a normal and ongoing expense. So add those personal expenses back in. That's gonna give you the true SDE, seller discretionary earnings, or cash flow. And that's the number that's gonna be used to market your business for sale. And that's the number that buyers are gonna use to value your business. Now, if you're thinking about selling your business and you need help with this process, check out the link in our bio. We'd love to help you.